Do you want to start investing, but you get kind of overwhelmed by all of the Wall Street lingo? In today's video, I'm going to go over some common investing terms and make them super simple and clear and easy to understand so that you can invest with confidence. This is the next video in our money management series, which I will link down below. So let's get started. Let's start by talking about why you would even want to invest in the first place. If you check out this chart, you can see what happens with $20,000 invested over the course of 30 years. And as you can see, if you stick it all under your mattress, you have $20,000 in 30 years and that's it. But if you were to put it into a savings account with a 2% return, you would have, at the end of 30 years, $36,000. You would have gained about $16,000 just in interest and compounding growth. However, if you were to invest that $20,000, you see the growth that can happen. You've got almost $80,000 worth of growth that comes by investing your money. But investing can come with its own sort of language that can make people nervous and leave us feeling like the only possible way we can safely invest our money is to pay someone else to do it for us. And I get it. That was us until very recently. We just started our own DIY investing journey. And a big reason why we did that was because we realized how much we were paying someone else to invest for us. And we knew that we could figure this out for ourselves because it really isn't that complicated. I just think that the people making the money from it want us to think that it is. Now, don't get me wrong, there are a lot of layers of investing that you can delve into, but for the average investor, which is what I would consider myself and what you probably are if you're watching my video, we can figure this out for ourselves. It doesn't have to be complicated, and I want to help demystify some of this so that you can feel comfortable, that you can feel like you can handle this yourself. Here, it's all His. Our vision is stewardship. Our vision is managing God's money, God's way for God's glory, and we're going to have to give an account for what we do with the money God gives us. And for us, that means we want to manage it ourselves. We want to manage it wisely rather than pay someone else to do it for us. So hopefully I can help you today to realize that a lot of these fancy terms are just simply not that complicated. All right, let's start with the first term we are going to discuss, and that is a security. So what is a security? It sounds kind of fancy, but a security is basically something that you buy and own or you can trade that has a monetary value, like a stock or a bond. It's that simple. So let's talk next about stocks. What is a stock? Well, a stock is a piece of a company that you buy. You are a part owner of a small share of a company when you buy a stock in that company. Because you own a share, you may be referred to as a shareholder. You hold a share, you're a shareholder. Super simple. If the value of that company rises, so does the value of the share that you own and vice versa. So let's talk next about what a dividend is. Now, a dividend is when you own a share of a stock in that company and that company chooses to share some of its profits with you. They will pay a portion of their profit to you for every share that you own, and that portion that they pay is referred to as a dividend. Most of the time, a dividend is paid in the form of cash. Sometimes it is paid in the form of more shares of the company. Basically, you're getting a little piece of their profits. Some companies that you may own stock in will choose to not pay a dividend. Sometimes if a company is newer or hoping to grow more, they will take their profits and they'll reinvest it back into the business for more growth. Whereas a company who's been around for a while may be able to take the profits and give some back to their shareholders. So not every stock will pay a dividend. Dividends are paid out at different times depending on the company. Some companies pay a dividend every month, some quarterly, every 3 months, and some will do it semi-annually or even annually. So let's look at an example of this. Let's say you own 100 shares in company A, and this company pays an annual dividend of $3 per share. At the end of the year, they will pay you $300 of cash in the form of dividends that you can do whatever you want with. Now, most people, as they're investing, will reinvest those dividends back into that company. They'll use that $300 to buy more shares of that company so that in the following year, they will get even more dividends, and they just continue doing kind of like it's a dividend snowball. You just continue to reinvest your dividends. This is a really smart move if you have a lot of years left till retirement and you want to help compound the growing of your retirement savings. However, later down the road, you could pull out those dividends and that could be income that you would live off of. One thing to know about dividend paying companies is they are not required to continue to pay you dividends. They're also not required to continue to pay you the same amount of dividends. They can increase it, they can decrease it, and they can get rid of it altogether. So that can make depending fully on dividend income a little bit of a risky tactic for your retirement plan. Although don't get me wrong, I think dividend income is awesome and it's definitely a part of our portfolio. It's just not where we put all of our eggs in that one basket. All right, let's talk next about what a bond is. A bond is a type of security or investment that you can hold that is essentially a loan you are giving to a government, which is usually what bonds are, and sometimes to a corporation. So let's just say it's a government. Think World War II war bonds. When the government needed to fund the war effort, they would issue bonds and they would ask you to give them money so that they could fund the war. They're essentially having you give them a loan. With a bond, they promise to give you back your initial investment in full at the date that they choose, which is called the maturity date, when that bond comes mature. As a reward or an incentive for you loaning them the money in the first place, they will agree to pay you interest periodically as you approach that maturity date. So if the maturity date is pretty close to the time that you lent them the money, the interest rate will be lower. And if it's a longer maturity date, the interest rate will be higher. Bonds are very secure because you're guaranteed to get your initial investment back plus a little bit more. This makes them a less risky investment. However, when you have a bond, you do not own a portion of anything. You don't own a portion of that government or even that corporation. So these bonds don't offer as much in the way of growth. So you get more security when you hold bonds, but you get less growth. This is why a lot of people, as they near retirement age, will shift more of their assets, their money, into bonds because they're more stable. They hold their value. All right, let's talk next about one of my favorite things when it comes to investing, and that is what Albert Einstein called the eighth wonder of the world, compound interest. Now, I have shared in other videos compound interest calculators. I love, love, love them. They're so much fun to play with, and I will link my favorite down below, and I would encourage you to have some fun yourself. If you think that's fun, I do. But compound interest is the investor's best friend. And if you take your money and you mix it with the beautiful ingredients of compound interest and time, you will see why it is just the best. Let's start by talking about what interest is. Interest is essentially a bank giving you a little bit of an incentive, a monetary incentive for keeping your money with them. So if you put your money into a savings account, in our high yield savings account, we get that interest compounded monthly, and every month they add a little portion of money into our account, which is kind of fun, passive income. When you're shopping around for a bank account with a good interest rate, you'll usually see it presented to you as an annual percentage yield, or APY. Compound interest is what happens when you get to reinvest the interest they give you and then earn interest on that interest. Think of it like taking a snowball and rolling it down a hill. You start with that initial investment, and as it rolls and rolls and rolls, it gets bigger and bigger and bigger as it increases in surface area, and you get a bigger ball by the time you get to the bottom of the hill. Compound interest, especially the longer the hill, the more time you have, it just grows and grows, and the effects are seen the more and more time you have your investment in whichever investment you choose to have it in, whether it's a bank account or a stock. The longer you let your money stay invested, the more intense that compounding interest effect is. And it's amazing. There's a creator that I really love called Next Level Life, and I'm gonna link a video down below to a really cool example of compounding interest that he does. His channel is just really good if you're a visual learner. Be sure to check him out if you want to learn a little bit more about how compound interest works. A really important thing to remember though is that compounding interest can work against you too. One place that we see this all the time is with credit card debt. Credit cards have a very high interest rate, and if you can't pay off your credit card every month, you will be charged that interest rate, and that will be added to your balance. And then the following month, that will happen again and again every month that you can't pay it off. And we're talking interest rates in the 20%. That can get really big, really fast. And that's what keeps people who only make their minimum payment on their credit cards in debt perpetually. Don't forget that compounding interest can be your best friend, but it can also be your worst enemy if you're in debt. Check out this video about different ways to pay off your debt. If that's something that you're struggling with, I would love to help you get out of debt. The next investing term that you might hear thrown around is risk tolerance. Essentially, risk tolerance is just how comfortable are you if you see your investments going up and going down. We have to remember that investing is a marathon, it's not a sprint. You're hopefully going to be in the market for 30, 40 years. You're gonna see upticks, you're gonna see downturns, you're gonna see periods of great growth. You really shouldn't be looking at it every single day anyway if that kind of stuff stresses you out. It's a long game. You wanna just keep investing, be wise about which investments you choose, and just stick with it. That's the point of investing. Stick with it. Are you comfortable riding out that roller coaster of investing? Or do you feel better with things that are a little more stable, a little less dips and rises, but you sacrifice growth to do that. How comfortable are you with riding out the ups and downs of investing? If you are okay with the dips because you're excited about the growth, then you have a higher risk tolerance. If you're very, very nervous about losing any of your investment, then you have a very low risk tolerance. You might benefit from a risk tolerance calculator. This is one that I found online. It is from Smart Asset, and you can see here that they sort of give you an idea. If you range from very conservative up to very aggressive, they sort of show you what percentage of your money should be invested in which things. It's really important just for you to know which risk tolerance level you're at, because that will help you pick and choose which investments you feel comfortable with. There isn't a right or wrong answer. It's all about what you feel is best for you for your situation. If you're closer to retirement age, your risk tolerance is probably going to go down because you want to conserve what you've grown. But if you're really young, you have time to ride the waves, you probably want to err on something that's a little more towards the growth end. This is very personal, like all of personal finance, and a lot of things can factor in, like your age, how much you have invested, what your goals are, things like that. All right, the next term we're going to talk about is diversify or diversification. Essentially what this means is that you don't put all of your eggs into one basket when you're investing. If you have all your eggs in one basket and you drop the basket, you lose all the eggs. But to keep this egg metaphor going, if you head down to the chicken coop and you have 3 different baskets for your eggs, you put eggs in each basket and you drop one of them, you've still got 2 baskets of eggs, right? Diversification protects against big losses, and it is the key to successful investing. You can diversify by owning different types of investments like stocks and bonds. You can also diversify by buying stocks in different what's known as sectors, which is again another investing term that just means different types of businesses. So you could buy stocks in a technology sector. Then you could also buy stocks in a healthcare sector. It's just different companies that produce different products and services. You can also diversify by buying companies of different sizes. So another term you might hear is large cap or mid cap or small cap. That's just large companies, medium-sized companies, and small companies. Remember that every large company used to be a small company at some point. So it can be good to diversify by owning a little bit of all different types of companies in the sense of their size as well. As you can see, there's a lot of different ways to make sure your eggs are in all kinds of different baskets. The next term we'll talk about, I actually mentioned earlier, and that is a high yield savings account. This is an account that you would keep your cash in. This is a great place to keep an emergency fund or potentially money that you're saving up for a big expense like a down payment on a home or a new vehicle, a vacation, a wedding. A high yield savings account is going to offer a competitive percentage of interest compared to what you would get maybe at your local bank or credit union, which is usually practically nothing in those savings accounts. A high yield savings account is the type of account where you keep your money liquid, which is another investing term that just means you can get to that money easily. So let's talk now about 2 other kinds of accounts. These are both retirement accounts or long-term investment accounts. We're going to talk about the 401k, 403b kind of account, or the IRA or individual retirement account. Let's start with the 401k. Whether it's a 401k or a 403b, really these are just tax codey types of words. They're not very interesting, but essentially they're the same idea. You have an employer who provides you the benefit of a retirement account. A 401k is the most common one, and it is offered by a private for-profit company to their employees. A 403b, on the other hand, is its counterpart. It's just offered to the employees who work for a non-profit tax-deferred company or organization. They both work very similarly, and they both offer, depending on the kind that you have, different kinds of advantages as far as your taxes go. The cool thing about these accounts is that your employer will often offer you a match for whatever money that you put in, up to usually a certain percentage. So they might say if you put in 5% of every paycheck, they will match you 5% or whatever percentage they offer. This is an awesome vehicle for retirement savings because for whatever you put in up until that percentage of the match, you're getting basically 100% return on that money. There isn't anything else in the investment world that promises you that kind of a return on your investment. And a return is essentially just what do you gain for what you put in. 100% is amazing. Now, an individual retirement account is the kind of retirement account you can open for yourself, whether or not you have a 401k or a 403b. There's also a variety of these that have different types of tax advantages. Now, both of these accounts come with different types of limitations. They will limit how much money you can put in every year, depending on your age. There can also be withdrawal penalties if you pull the money out before you hit a certain age. And sometimes these accounts will force you to take the money out in certain amounts of disbursements or just withdrawals of that money when you hit a certain age. For now, just to keep it simple, think of these accounts, 401k, 403b, or the different types of IRAs, as baskets. If the eggs are your securities, if they're your stocks and your bonds and the things that you're investing your money in, you would take those eggs and you would put them into these baskets. You'd put them into your 401k or you'd put them into your IRA. They are places to hold your investments. I hope this video helped you with just some basic understanding of investment concepts. I'm already planning the next video because there are more terms that I really want to demystify for you so that you can feel comfortable with your own investing. If there's an investing term you want simplified, leave it down in the comments below and click into this playlist to watch the rest of our money management series, and I'll see you over there.